Welcome to Covered, Health Insurance Explained. In this video, we walk through the Individualized Coverage HRA, or ICHRA for short. We know navigating health insurance for your employees can feel like climbing a mountain of confusing terms, conflicting opinions, and strange acronyms. We know employers have a lot of decisions to make already for their employees. Mike Combo from Anderson ZurMuehlen joins the co-op for a presentation on this new plan and covers exactly what you need to know. Enjoy!
We're here to talk about the individual coverage health reimbursement arrangements. That's a mouthful, so I'm going to phonetically pronounce it ICHRA. It's just a little bit shorter, easier for me to say. This is new. Like Richard said, the IRS came out with some regulations on the operation of this summer. We don't have 100% guidance, but we have pretty good guidance on how this will work. Starting January 1st of next year, any employer of any size can reimburse employees for their individual health insurance coverage and individual medical expenses. So it's a different way where the employee can control the cost. This is funded by the employer, so this is employees are at least with it through the ICHRA are not participating. This is 100% funded, but you control the amount they're funded. There's no caps. If you want to reimburse $5,000 a year per employee or $50,000 a year, you have that flexibility to do it. And you can discriminate among classes. You can set up classes and have different level benefits, and we'll go through that. That's an important part of this plan. The qualified small employer, the short term is that is Qsara. It's very similar to this. We'll go over that a little bit in the difference. It's same concept where you're reimbursing employees for individual coverage. It's a few more restrictions on that. I think this is a little more flexible, and I think a lot of people will like this a little bit better. But like I said, there's no requirements for the employer. There are requirements for the employee to be able to participate in an ICHRA. So the first one is they have to have minimal essential coverage, which means under the Affordable Care Act, insurance policy has to meet certain criteria. You have, as an individual, have to have that as well. Or Medicare, you can reimburse Medicare, you would qualify, and the Medicare supplement. So you can reimburse somebody for Medicare and their supplemental insurance that they may have with Medicare, which, yeah. So that's a nice benefit of this. Yeah. So that is a good thing. You're not eligible as a participant if you're covered under your spouse's plan, which makes sense. If you're under your spouse's and they're getting it pre-tax or their employer's paying for it, you can't double dip and take a distribution or reimbursement from your current employer. Short-term insurance plans don't qualify, and healthcare share ministry plans, even though you can have one of those, you can't have that reimbursed through an ICHRA. So you want to make sure you let your employees know that. Like I said, any business can decide how much they want to contribute. You can level the benefits based off of specific classes. There are 11 classes. One class is not, owner, non-owner, or how much I make. You can't divide based off of wages. And employees, they have to substantiate to you every year that they have qualifying coverage. So that's one thing they have to know.
Sorry, did you say you can or cannot discriminate between classes? Because I thought you said you could.
You can.
You can.
Yeah. Yep, you can within. You can have different class levels. The 11 class levels are full-time employees, part-time employees, hourly employees, seasonal, temporary employees, or employees based in different locations. So you have multiple branches. You can have one branch be in a class and another branch be in a class. Foreign workers who work abroad, you could segregate them out and have them as their own class. And your union employees, so if they're covered by a collective bargaining agreement, they can be segregated into their own class and have their own benefit. And you can have an employee waiting period. If you have employees, you want to wait 90 days before they're eligible, you can make that a class, and then they can start coverage after that time period. And you can mix and match. You can have multiple classes. If you want to have a class full-time, hourly employees, that could be a class. You can segregate them out and have a class. So there is some variance there, a little bit of, we'll go through some of the requirements of classes, but there's some flexibility there. which makes some sense. Within a class, so if you have different classes, within that class, you have to provide the same benefit level. So you can't discriminate within a class. You have the separate classes. You can have one level and then a lower level, but within that class, it has to be the same with two exceptions. The first one is family size. So if you want to provide a benefit for your single employees at one level, have a higher level for the married, and then maybe even have a third level for a married couple that has kids or you have dependents, you can vary the amount you reimburse based off of that. And the employee's age. You can reimburse different levels depending on the employee's age. The caveat there is you can't have the benefit more than 3 times that of the youngest employee. If you have an employee you're going to give a benefit, a single employee, maybe it's $5,000 a year, your older employees can't have more than $15,000, so it's a 3-time. And that mirrors under the Affordable Care Act. When you buy a plan on the exchange, that's the same limit there is three times. They can't discriminate more than 3 times that. And that age is kind of a nice feature because under a group plan, it's one premium for everybody. So the younger people are somewhat subsidizing the older employees. This would allow you, younger employees, to have a smaller benefit when maybe their need isn't much. Their insurance is cheaper anyhow, so you can mirror the benefit to match what their costs are. Another feature is you can still offer a group health plan even though you have an ICHRA. So you can offer one class a benefit of a group health plan and another class an ICHRA. But within the same class, you can't have a choice. It's one or the other. So if you have a class of hourly employees and you have a group plan, for that class, everybody has to be on that class. They can't have a choice between an ICHRA and a group plan within the class, with one exception, and that is exception for new employees. Now, you may be an employer that has employees that like the group plan, and maybe you want to phase in your ICHRA plan over time. And you can set a date where anybody hired after that date will automatically go on the ICHRA, and everybody else will continue to have the plan, the health group plan. So there's no choice. You have a cutoff date, but that does allow you to phase it in over time, especially if you have employees that like the plan that they're on right now. The class sizes. We talked about the different class sizes. There is a minimum size class in some circumstances where the class size has to be a minimum, and that is if you're offering a group health plan and an ICHRA. So if you have both of those, one class may have an ICHRA, another class may have the group health plan. If you have that situation and your classes are based off of these 5 class size requirements, full-time employees, part-time employees, salaried employees, and employees who in different locations maybe have a different rate, if one of these or more of these are part of your classes, then you're going to be subject to the class size requirements. So those requirements are anyone under 100 employees, the minimum class size has to be 10. So if you're an employer with 10 or fewer employees, you can't have different classes because the minimum class size is 10. Between 100 and 200, it's 10% of what your full-time employee base is. If you have 150 employees, for example, your minimum class size is 15. And then when you hit the 200 employee size, the minimum size is 20. So from 200 to 2,000 employees, doesn't matter, the class size has to be 20.
And that's full-time employees?
Yes, that's full-time, correct.
This is if you have both?
This is if you both have an ICHRA and a group plan, and your classes are based off of one of those 5. So if you're only offering a group plan or you're only offering an ICHRA, let's say that the ICHRA is all you have, this doesn't apply. So they just don't want to make people aren't setting class sizes up to just give in proportionate benefit to a few people. That's the rationale there. Then the class size is dependent on the first day of your plan year. So if it's January 1st, that's the date you set. So if you have 10 employees on January 1st, somebody leaves in July, you're not disqualified for that year. You can keep that class, but come the next year, you're going to have to put those employees into a different class, unless the IRS comes out with some guidance on safe harbors or something, but I haven't seen anything on that. But it is based off the first day of the year. The allowable expenses that you can pay, you can have insurance or qualified medical expenses, which are medical expenses that you would get a tax deduction for on your personal return. You don't have to offer both. If you can have a plan that just has health insurance reimbursement, or you can have a plan and it has expense reimbursements as well. And you don't have to reimburse for every type of expense. You can limit it. If you wanted to offer a benefit of health insurance allowance plus an allowance for just prescription drugs or just hospital visit, you can do that. You can limit it. It doesn't have to be all, which kind of helps you control the costs. So there is some flexibility there. So it doesn't preclude someone from having an HSA. So if they go out on the marketplace, if they go out and get a plan that would otherwise qualify for an HSA, they can still fund an HSA, or you could still fund the HSA. Or if you have post-deductible expenses that aren't covered by the HSA, you could reimburse for those expenses as well. So there is some flexibility, and they still want people to.
It's not real clear. In other words, the ICHRA can pay your health insurance premium. What is that saying up there?
Yes.
Allowable expense is health insurance.
Right. That's one of the allowable expenses. The premium.
They could pay your premium on your personal insurance.
Yes. Yep. That's the whole concept of the ICHRA is you go out and they'll pay. You set the allowance as an employer. You can say we're going to reimburse everybody $5,000 a year for health insurance. You go out and get health insurance. If yours costs $8,000, then you'll pay personally the $3,000. But they can also say we're going to give you an allowance of $10,000. That's going to cover health insurance plus your out-of-pocket costs. So they would pay the monthly premiums, and then you go see the doctor, go to the hospital bill. You submit that expense to the plan, and then they reimburse you as a claim. So that's kind of the overall framework of how it works. There's some other considerations you'll want to think about before deciding on one. Does anybody here have more than 50 employees? But if you have 50 employees, then you're mandated to provide health insurance to your employees. Your allowance still has to be providing for affordable coverage under other ACA agreements. So you need to consider that. IRS will come out some guidance on what that means. It's pretty easy to determine under the law if you have a group plan what's affordable because you know what the premium amount is in advance. But if you have an employee that maybe they have qualifying coverage that's $1,500 a month, but they pick $2,500 a month, and then that doesn't meet, you do the testing and it says, well, that's not affordable. That's not your responsibility. So they understand that, IRS understands that, and they'll provide some guidance and some safe harbor in the future. So stay tuned, but there is that. If an employee goes out and gets a plan on the exchange, they're not allowed to get a premium tax credit or a subsidy if they're in the ICHRA. So that bars them from getting that. So that's one thing to consider. If an employee wants to opt out, you have to allow them to opt out for one. But if they want to opt out because they feel they can get a better deal and get a subsidy, then that's
They can't have both the subsidy and an ICHRA.
correct. They can't get that. Yep. And some of the plans, depending on your plan document, and this does have to you do have to have a plan document that spells out how your plan's going to work. If you're going to have classes, what your benefit amounts are. It is a written document. Depending on how it's written, it could fall under ERISA laws. The DOL said, be careful because you may fall under ERISA laws, and then you've got that whole slew of rules to have to follow. So on that. You can coordinate payments that an employee would have to pay through a cafeteria plan. They can still run cafeteria plan. So again, if you had a benefit of $5,000 a year and somebody's plan for them and their dependents was $8,000, they could run that $3,000 through a cafeteria plan if you have a cafeteria. So they can at least still get their part tax, pre-tax. If somebody goes out and gets a plan on the marketplace, would qualify for a subsidy through an exchange, under current law, that is not allowed to be run through a cafeteria plan. That would have to take congressional approval. They've talked about fixing that. I mean, they kind of understand that, this is a different deal. I haven't seen any updates at that, have you? I mean, I looked last.
Anytime soon.
Yeah, I mean, they understand that. Hopefully they'll come in and change that. It makes sense to allow that. As part of your plan every year you have to provide notification to your eligible employees that you have an ICHRA, similar, and you provide them with the plan summary or the plan document so they understand the benefits, so they have the option to opt in or opt out. But that is there are notification requirements just as you're doing that. This last slide here, it's kind of busy, so Richard provided that, which is nice. This compares the ICHRA to the qualified small employer health reimbursement arrangement, or we'll call that a Qsara. So you can see the differences, why you might want one over the other. Both of them are reimbursement plans, so they're not group insurance. They're a reimbursement where you set the dollar amount of how much you're going to reimburse employees for premiums and medical expenses. The ICHRA, as we said, there's no requirements for employee, no limits to the employer. A Qsara has a limit of 49 employees. It has to be under 50 employees or you don't qualify to offer a Qsara. So that's the difference. Qsaras came out first. These came out second. On a Qsara, every full-time employee is eligible for the plan. So there's no classes. It's once you're employed and you're eligible, you can elect to be in the plan. You can cover part-time employees, but you don't have to. That's really how you have to do it. So in a Qsara, you can participate in a minimum. You don't have to have minimum essential coverage to be included in a Qsara like an ICHRA. You have to have the qualifying insurance. You don't have to in a Qsara, but if you don't, you're taxed on the benefit. So there's a little bit of nuanced difference there. But the Qsara has annual limits on the benefits that you can provide, whereas in ICHRA, you can provide whatever benefit you want to different classes. On a Qsara, there are annual limits. 2019, it's $5,150 for single coverage, $10,450 if it's for family coverage. So there are caps. The premium tax credits, we talked about ICHRA, does not allow you to get a premium tax credit if you participate. In a Qsara, the employees can still get a tax subsidy or a premium tax credit, but it's reduced by the amount of the benefit they get from the Qsara. But it does add some flexibility. It's a nice thing where an employee, if you offer that benefit, the employee can still can go to the exchange and get a credit. That's probably the one advantage over Qsara, over ICHRA. And in the Qsara, you can't provide a health plan for your employees. It's the Qsara or nothing, where under the ICHRA, remember we said you could have a qualified plan, group plan for one class and an ICHRA for another class. The Qsara is, you can only have the reimbursement. Sure.
If you have no classes, like it's an employer that's like, we don't do classes, can they still have both the ICHRA and the group policy?
No.
So they have to have
Yeah.
one or the other?
Yeah, because they're within one class. And
That's considered just one class if there's no classes?
right, yeah. The only difference would be it's on new employees. You could put them into the ICHRA and everybody else stay on the plan.
Stay on the plan.
Yeah.
So you could pick and choose only for new employees?
Right.
Okay.
So basically you'd be phasing out the group plan over time. So good question.
On the Qsara, so if your employees don't have insurance, they don't have their own health insurance, you can still reimburse them for their medical costs?
Yeah. But it's taxable.
But how do you determine then what costs you can cover?
It's the same. Basically, think of it as I can take a tax deduction on my personal return. That would be a qualifying expense.
Okay, so if there are things that you
Right.
wouldn't qualify.
Right. You couldn't reimburse a health club membership because you can't take a deduction for that. But prescription drugs, yeah, they can take a tax deduction for that. So It just becomes a taxable benefit.
Without MEC, what's MEC?
Minimum essential coverage.
Okay.
So in the Affordable Care Act,
Affordable.
insurance plan has to meet, like preventative care, there's certain pediatric dentistry, all those things where it has to meet a certain level. That can't be lifetime limits is another one you have to have. So if you have those plans that don't meet those requirements, you can't be in an ICHRA. You can still be in a Qsara, it's just taxable. So that's all we have. I don't know if there's any other general questions that we didn't have. I mean, determining between the two, I mean, it's kind of facts and circumstances of what you want to do. The bigger the organization, I would